Is APRA actually telling banks to go negative interest rates on their mortgage products? In this video, I'm going to discuss with you what they're actually saying to banks, what banks may actually do, and when we could actually see negative interest rates, and what that means for Australian property. If you're interested, keep watching. Hey guys, my name's Ravi Sharma and welcome back to Personal Finance with Ravi Sharma. On this channel, we talk about cryptocurrency, real estate, and financial freedom. So if you're interested, definitely smash that subscribe button and drop a like for the YouTube algorithm to share these videos out to the people that really need it. Now, I have actually just released my Patreon community. So it's a membership-based community, which you can find a link in the description below to a video that explains everything about Patreon and the memberships. And I share a lot more of the research that goes in on behind the scenes for when I'm coming up with these videos and, my conclusions and thoughts. There are so many benefits, but of course, check out that video if you feel like it's something that you want greater access to and having more conversations directly between you and I, then definitely consider becoming a patron in that community. Now, APRA is telling banks that they should start preparing for negative interest rates. Now, what does that exactly mean? Well, they're trying to get banks to actually now start figuring out in their back end, can they consider an environment where negative interest rates is a reality? This is pretty much a warning sign from APRA to the banks that, hey, look, I get it, the RBA guy is coming out and saying maybe we're not going to have negative interest rates is highly unlikely. And a lot of other people around the world are saying, no, Australia is not going to have negative interest rates. However, APRA has made it a point to start going, hey banks, maybe you should start considering if you can even implement zero or negative interest rates. Now, why would they be doing that? Just for fun? I don't think so. I feel like there is a lot more happening in the background that you and I may not get access to, but with research, with time, and with a lot of experience in and around what's happening just on the economic front, but as well as on the micro and macro side, I think you can start drawing a conclusion. Now, it's very interesting to see how this conversation has changed from banks coming out only, I guess, a month ago saying interest rates are rising. Now, I've got a video on this channel where I discuss my thoughts on that and how I thought it was very unlikely for it to be a sustainable move. Now, a month later, we've got APRA saying, hey, banks, maybe we need to consider negative interest rates. But why? I think with the lockdowns, with not just Australia going into lockdown, the increase in restrictions across the world, you've got social unrest in many parts of the world now, you really got a bit of a change that we don't really think we've come out of this recession or this lockdown COVID pandemic, induced recession. And I think what we're going to see is the potential for a double dip. So in this video, let's discuss what APRA is actually saying. APRA tells banks to be ready for negative interest rates. The prudential regulator wants banks to be prepared for zero or negative interest rates and has called on them to all reasonable steps to ensure their technology systems can deal with extreme monetary policy settings. Okay, very interesting. The Australian Prudential Regulation Authority said on Monday it wrote to banks 7 months ago asking them to tell the regulator if they would have any issues implementing negative interest rates. So again, they've already had this discussion 7 months ago. Now they're reminding them, hey, did you guys go check up on all that stuff? Why would we be considering this 7 months ago? I wonder what was happening 7 months ago. That would put us at the start of this year, which apparently was meant to be this huge growth year. And, COVID was done, lockdowns were done, everything was back to normal. I remember having conversations with a lot of people where they were like, I can't wait to 2021. Everything's going to go back to normal. No, I don't think it works like that. Just because the new year comes around, it's just another date. And it wasn't just going to automatically change. And we're clearly seeing that now. The Reserve Bank has said many times that a negative cash rate would be highly unlikely. They didn't say it was impossible. Such a setting could support economic activity by keeping downward pressure on borrowing rates and exchange rates, but negative rates could also make it harder for banks to lend and encourage saving over spending. Of course, when you've got interest rates coming down, that also adversely affects the savers because they're putting their money into the bank. I'm not sure why you would still be doing that, but you put your money into the bank and you earn that interest. Now that is correlated to what they're giving out, the loans out for. So that percentage is correlated. Now, although, savings rates are like 0.1% versus a 3% home loan, into the bank's margins and, how they make profit. Banks' responses show they are typically well placed to deal with negative market interest rates on products managed by their treasury operations, APRA said. But some banks pointed to operational challenges if negative rates were put on lending and deposit products, which means customers would pay banks to park funds with them Other banks flagged the cost of fixing existing systems to deal with rates in the negative. It's pretty much an upside down world. At the moment, and forever in Australia, we've been accustomed to going to a bank, getting a loan, and say that interest rate is like 2.5%. Now what we do is we say borrow $500,000, we then pay our principal back, right, if you're on interest and principal, but the cost of borrowing, which is the interest, would be 2.5%. So you're pretty much going, thanks Mr. Bank, I've now got my property, I will pay you 2.5% for the next 30 years as a percentage for the fact that you've given me a loan. Now, in an upside down world, which is a negative interest rate, they would do the opposite. So they would come to you and say, hey, Mr. Ravi, if you want to borrow money, why not get a loan, but we'll also pay you to take the loan. Now that's like freaky stuff, right? If you really consider what that could do to the economy, both negative and positive, it would have huge ramifications. But more on that later. APRA said at the very minimum, banks should develop tactical solutions, short-term fixes to create workarounds on existing systems to implement zero and negative market rates, cash rate, by April 30, 2022. It wants this done for all products referencing the cash rate or a market interest rate. This includes business lending, residential mortgages, personal loans, and credit cards. Wow. April 30th, 2022. So there must be something happening in the background. APRA said it would finalize its expectations by October 31 and wants feedback by August 20th. Its focus on a potential negative interest rate would come as financial markets consider the Reserve Bank might lift official rates faster than Governor Philip Lowe's insistence that rates will not rise before 2024. Now, I've said on this channel that although the RBA comes out and says, hey, we're not going to do this, they're probably going to do the opposite. So despite him saying we're not going to rise before 2024, you better believe if inflation kicks in and everything's back to normal, he's going to increase that cash rate a lot earlier than 2024. Now, my personal belief, I'll leave to the end, but I think you know where I'm going with this. The prudential regulator acknowledged the RBA's position that negative cash rate is unlikely. Dr. Lowe said in December it was extraordinarily unlikely the central bank would adopt such a position, which would involve clear costs, including on the supply of credit by making it harder for banks to lend. But APRA said it still wanted banks prepared. Why would they want that? Because it's possible that other interest rates determined in the financial markets could fall to zero or below zero at any time. Negative interest rates have been implemented in Europe, Japan, Sweden, Switzerland, and Denmark. The Reserve Bank of New Zealand has also asked Australian banks to be prepared for negative policy rate. It sent a similar communication to APRA's December letter in May last year. Okay, so there's like a handful of countries already doing it. They've been doing it for a while. You've got Japan who's been doing it forever. And I'm not saying it's negative or positive, okay? What I'm trying to say here is that the possibility of something so whacked, right, being upside down, it is possible. And you've got now someone being, really close to us, the Reserve Bank of New Zealand, also considering it, which blows my mind, right? Because when you see the growth numbers that New Zealand has actually had across residential property, it will blow your mind. If you think Australian real estate has grown quickly over the last 12 months, just have a look at the New Zealand numbers. It's crazy. So the fact that even they are suggesting, hey, APRA, maybe you guys need to start looking at these things, because if we're not prepared for the next phase of what's coming, then we're just going to get left behind. We won't have the systems and the whole economy will come to a crash. So they are preparing for something big. APRA said there are risks if banks are not prepared for zero and negative interest rates, and there are material enough to trigger its prudential standard CPS 220 on risk management. It wants banks to ensure they have controls to address operational risk in a negative rate world, and wants them to consider the potential for conflicts of interest and the fair treatment of customers. Fair enough. Banking analysts say negative interest rates would be negative for bank earnings. In an analysis of the prospect of negative rates published last year, Macquarie banks would be able to navigate the negative rate environment through repricing measures, but earnings headwinds will be difficult to offset in full. Banks with a higher proportion of deposit funding would be more adversely impacted as they will lose their funding cost advantage, Macquarie said. Really interesting stuff. Now, before I continue as to what my thoughts are, in the Patreon community, I've actually been sharing a lot more detail around my research, and it comes across a research paper in a journal, which was stated in 2016, and that talks about negative interest rates and housing bubbles. So it's something that if you are interested in deeper diving into and learning about the back end, which I think is super important, especially when you're looking at hey, I could look at financial freedom through real estate. I better know what causes the triggers and cause effect of, interest rates going up or down. So if you are interested in that sort of stuff, again, Patreon link in the description below. But my analysis of what's happening in the market at the moment and what I think is going to happen, a couple of months ago, I was actually having really deep discussions with a close few people, and I said, hey, I think we may go into another lockdown. And they sort of looked at me and said, well, what would induce another lockdown if we've already got, contact traces and we've got QR codes? Why would we see another lockdown? Well, for me, it just made sense that we needed some sort of event to be the catalyst for, say, getting vaccines and things like that. Now, I don't want to go down that path, but what I'm trying to say is that it seems like there is a bit of coordination in how we do these things. You've got banks that all came out a month or so ago that came and said, hey, interest rates are going up. But then every single bank did it at the same time, which seems very, very sus. But my thoughts on interest rates is that we're not going to see an increase for any time soon. Now, could we see negative interest rates? I think it's very unlikely. You see what I'm doing there? But the possibility is very much possible because anything goes. The fact that people are still comparing what happened in 2008, 2009 to what's happening now, we've got differences that are like monumental. We've got more quantitative easing than ever before, more money being printed as a result of that, which means more money supply. We then have banks coming out and saying loan deferrals are allowed, so you've got pausing of loans. You've then got stimulus through the roof. You're getting paid to sit at home in lockdown. You've got cops roaming around the streets to keep you at home. Are you telling me these things are different to what 2008 and 2009 were? Yeah, they are. So how could you still assess whatever we are seeing right now in the environment of economics and the markets and real estate like you were assessing in 2008, 2009? I'm saying we can learn from those things, but the market doesn't just do the exact same thing as it did previously. So this is where my word of caution is. We need to be very, very clear with our investment strategy. It's not about just going and over leveraging yourself because you think interest rates are going to fall. For me, I have a plan, right? I'm not a financial advisor for you guys, right? I'm just some random guy that sits there and makes YouTube videos. Now, for me, it's interesting that if an interest rate drop happens, what that could mean for my overall portfolio. Now, this comes down to a video I made around debt and inflation. Go and check that out because I think what I was saying 12 months ago, what I said 6 months ago around interest rates and where I think, the possibility of negative interest rates coming in, I said 12 months ago it would happen in and around Q2, Q3 of 2022. So it's interesting. They're saying April 22. They've just come out and reminded the banks of that again. What is that going to do for interest rates? What is that going to do for real estate? My thoughts are that we are going to see no interest rate increases for a long time. And anyone that's thinking that, great, good on you, because I'm sure you have your reasons. But the thing is, a lot of things right now in the markets are all bubbles. If you're getting propped up by the government through fake money, of course, everything's a bubble. Whether you take it through cryptocurrency, real estate, shares, everything is overvalued, but it doesn't need to make sense. You just need to know what you need to do as part of your plan to prepare for both worst case and best case. And you want to have some skin in the game because what I think is happening in the next sort of 6 to 10 years is going to be insane. So again, if you are interested in watching more of these videos, then definitely subscribe to the channel. If you want more in-depth sort of research, more of my thoughts, my opinions, which I can't really share here on YouTube, definitely go and subscribe, become a member on the Patreon community. Sign up for a month. If you don't like it, you can leave. But I'm sure that with the content that we are talking about, the research, it has never been more relevant and it's more important now, more than ever, because there is a big transfer of wealth happening right now. I just want you guys to be on the right side of that. I'll catch you guys in the next video. Thanks, guys.